Hey everyone, and welcome back to the channel. Today I have a very urgent and time-sensitive message for anyone involved in the gold market. Whether you're a seasoned trader or just thinking about dipping your toes in, what I'm about to share could save you from a massive financial headache, so please listen closely. The title isn't clickbait. There are serious reasons why you should be extremely cautious about trading gold right now. We're seeing signs of massive margin calls and forced liquidations across the board, and this is creating a perfect storm for extreme volatility. So what exactly is happening? Let's break it down. In simple terms, a margin call happens when a trader's account value drops below a certain required level. Their broker essentially says, hey, your bets are going against you, and you don't have enough money in your account to cover your potential losses. You need to deposit more money, or we're going to start closing your positions for you. This closing your positions for you part is what we call forced liquidation. The broker sells off the trader's assets, in this case gold contracts, to cover the debt. Now, imagine this happening not just to one or two traders, but to a massive number of them all at once. That's the situation we're potentially facing. When a wave of forced liquidations hits the market, it creates a cascade effect. Brokers dump huge amounts of gold onto the market, not at a price they want, but at whatever price they can get. This sudden flood of supply causes prices to plummet, often very quickly and violently. This is not your typical orderly market movement. This is chaos. The initial price drop triggers even more margin calls for other traders who are also leveraged. Their accounts, which might have been safe a moment ago, are now suddenly underwater. So they get margin called and their positions are also forced sold, pushing the price down even further. It becomes a vicious, self-perpetuating cycle, a downward spiral that can wipe out accounts in minutes, not hours or days. This is what traders fearfully call a liquidity cascade, or a margin call doom loop. So, why is this happening right now, specifically with gold? There are a few key factors at play. First, we've had a significant run-up in the price of gold recently. A lot of traders, especially retail traders, jumped on the bandwagon, going long on gold with high leverage. They were betting that the price would just keep going up. Leverage is a double-edged sword. It magnifies your profits, but it also magnifies your losses. When you have a market that's heavily saturated with leveraged long positions, it becomes incredibly vulnerable to a sharp reversal. Second, we're seeing some major macroeconomic shifts. Think about recent data on inflation, interest rate expectations from central banks like the Fed, and geopolitical news. Any piece of unexpected news can be the catalyst that pricks this speculative bubble. For example, if a report comes out suggesting inflation isn't as high as expected, or that the Fed might be more aggressive with rate hikes than previously thought, the primary reason for holding gold as an inflation hedge weakens. The big institutional players, the smart money, might start to sell off their positions. This initial selling, even if it's relatively small, can be enough to push the price down just far enough to start triggering those first margin calls for the highly leveraged retail traders. And once that domino falls, the cascade begins. We're also seeing some technical signals in the charts that are flashing major warning signs. We've seen what looks like a failed breakout, where the price tried to push higher but was aggressively rejected. This often traps a lot of bullish traders who bought at the top. We're also seeing bearish divergence on key indicators, where the price is making a new high, but the momentum indicator is making a lower high. This is a classic sign that the upward trend is running out of steam and a reversal is imminent. When these technical signals align with the fundamental backdrop of a crowded, over-leveraged trade, it's a recipe for disaster. So what does this mean for you? If you are currently holding a leveraged long position in gold, you are in a very precarious spot. A sudden price drop could wipe out your account before you even have a chance to react. My urgent advice is to seriously consider reducing your exposure or getting out of the trade altogether. It's better to miss out on some potential upside than to risk a catastrophic loss. Taking a small profit or a small loss now is infinitely better than facing a margin call and having your entire account liquidated. Remember the number one rule of trading: capital preservation. Your first job is not to make money, it's to not lose the money you have. If you're thinking about shorting gold, betting on the price to go down, you also need to be extremely careful. While the setup looks bearish, volatility in these situations is off the charts. You could see massive, violent swings in both directions. The price could drop hard, then suddenly rip back up as some shorts take profit, only to crash again. Trying to time your entry and exit in such a chaotic environment is like trying to catch a falling knife. You can get seriously hurt. Unless you are a very experienced trader with a solid risk management plan, it's probably best to just stay on the sidelines and watch. And for those of you who are considering buying gold for the first time, today is not the day to do it. Don't try to be a hero and buy the dip. In a forced liquidation scenario, the dip can keep on dipping much further than anyone expects. You could buy in, thinking you got a bargain, only to see the price collapse another 5 or 10%. The best thing you can do right now is wait. Let the dust settle. Let the margin calls clear out the weak hands. Let the market find a new equilibrium. There will always be another opportunity to trade. The market isn't going anywhere. Patience is a virtue in trading, and right now it's your greatest asset. So, to summarize my key message, the gold market is currently in a high-risk state due to the potential for widespread margin calls and forced liquidations. This can lead to extreme and unpredictable price swings. If you're long, consider reducing your position or exiting. If you're thinking of shorting, be aware of the extreme volatility. If you're new, just stay out for now. Protect your capital. Don't be a hero. There will be safer, clearer opportunities to trade in the future. The goal right now is to survive so you can trade another day. I know this might sound alarming, but it's crucial to be aware of these risks. Successful trading is all about managing risk, and right now the risk in the gold market is exceptionally high. Please, take this seriously. Review your positions, check your leverage, and make sure you're not overexposed. Don't let FOMO, the fear of missing out, dictate your decisions. Let logic and prudent risk management be your guide. That's all for today's urgent update. I hope you found this helpful and that it helps you navigate these choppy waters safely. If you got value from this video, please hit that like button and subscribe to the channel for more market analysis and trading insights. Stay safe out there, and I'll see you in the next video. Thanks for watching.